All right, let's jump right in. Today we're going to break down one of the most powerful ideas in all of investing, the economic moat. If you've ever wondered what separates a pretty good company from a truly great long-lasting one, well, you are in exactly the right place. We're going to get into what it means for a business to be built to last.
Look, before you put a single dollar into any company, this is the one question you've got to ask yourself. Seriously, it's not just about what the company's doing right now, today. It's about whether it has what it takes to thrive for the next 5, 10, maybe even 20 years. And the answer to that question, it's all about its moat.
The castle analogy is just perfect, isn't it? I mean, picture a medieval castle. What was its number one defense? A deep, wide moat. And in the business world, you've got these invading armies, your competitors, who are always trying to steal your profits and your customers. An economic moat is that protective barrier that keeps them out, safeguarding a company's riches for the long haul. Now, this is a really important distinction. A lot of investors, they get stuck on that first question. Hey, is this stock cheap? But you know, the real legends of investing, they focus on the second one. Why? Well, think about it. A cheap company with zero defenses, that's a value trap waiting to happen. But a great company with a strong moat, bought at a fair price, now that is an engine for compounding your wealth for years and years. And that's the difference we're here to understand.
So, the big question is, how do you actually spot these moats out in the wild? Well, it turns out they usually come in 5 main flavors. The best way to think about this is like it's your personal analytical toolbox for telling the difference between a flash in the pan and a truly great business. Let's open it up.
Okay, first up, the brand moat. This is all about the invisible but incredibly powerful force of a name that people just trust, they desire it, and they're even willing to pay extra for it. I mean, why do people line up for a new iPhone? Or why do you instinctively reach for a Coke instead of the store brand cola? It's this deep emotional connection, and that trust translates directly into higher prices and some seriously fat profit margins.
Next, we have the cost advantage moat. This is for the company that is just the most efficient operator in the game, period. Companies like Walmart or Costco, they have their supply chains and their logistics dialed in so perfectly, it's like a science. This lets them sell stuff cheaper than anyone else can. And for a competitor to even try to match their prices, they'd have to burn through mountains of cash. It's a really formidable defense.
Our third moat is an absolute powerhouse, network effects. This is where a service gets more and more valuable the more people use it. It creates this amazing virtuous cycle. Think about Visa, right? The more stores that accept it, the more useful it is for you to have one. And the more people who carry a Visa card, the more essential it is for stores to accept it. It just feeds on itself, creating this incredible loop that's almost impossible for a new player to break into. This one is all about being sticky. It's when a company's product gets so deeply woven into a customer's life or their daily workflow that the sheer pain of leaving is huge. I mean, just imagine a big company trying to switch its entire workforce from Microsoft Office to something else. The cost, the retraining, the disruption, it would be an absolute nightmare. This locks customers in and creates a super predictable, reliable stream of revenue.
And last but not least, we've got intangible assets. These are these powerful advantages that are protected either by law or just by being top secret. Think of a drug company with a patent on a blockbuster drug that's basically a government-stamped monopoly for years, or a chip designer with secret tech that's a decade ahead of everybody else. These moats are so strong because they're like legal fortresses or secrets that you just can't copy.
Okay, so we know the theory, but here's the thing. Any company can claim it has a moat. Your job, as an investor, is to put on your detective hat. You have to ignore all the fancy talk and go find the hard evidence in the numbers.
A real moat always leaves clues. The first place you want to look is for consistently high return on invested capital, or ROCIC. That's really just a fancy way of asking a simple question. For every dollar the company puts back into its business, how much profit does it spit out? Great companies spit out a lot. After that, look for things like stable market share, the power to raise prices without everyone running for the exits, and a customer base that's super loyal. These are the footprints of a genuine moat.
Now, this is a crucial point. Moats aren't permanent. They're alive. They're either getting wider or they're shrinking. A widening moat is a beautiful thing to see. You'll see profit margins expanding, returns getting better, customers sticking around. But a shrinking moat? Whoa, that's a huge red flag. If a company has to keep cutting prices just to stay in the game, you're watching its competitive advantage erode in real time.
Okay, enough theory. Let's see how this stuff actually plays out in the real world.
Looking at real companies you know is the absolute best way to really get the true power of an economic moat.
Let's start with a giant, Apple. Apple is a masterclass in combining moats. First, you've got that world-class brand that lets them charge premium prices. But then they layer on top these incredibly high switching costs. Once you're in that Apple ecosystem, with your iMessages, your photos, your apps all synced up, leaving is a massive headache. And the proof is right there in the results. Unbelievable customer loyalty and just staggering profits.
Casco is just a textbook example of the cost advantage mode. Their entire business is built on ruthless, relentless efficiency, which lets them sell goods at razor-thin margins. The membership fee? That's where they make their real money. And it creates this incredibly loyal base of customers who come back again and again for the deals. It's a model that sounds simple, but it's almost impossible to replicate at their massive scale.
When it comes to high switching costs in the creative world, Adobe is king. Their products, Photoshop, Premiere, Illustrator, they are the industry standard. An entire generation of creative professionals has built their entire careers on these tools. For a design firm to just switch to a competitor, they'd have to retrain their whole staff and mess up all their workflows. That is a powerful, sticky moat.
Whew, okay, we've gone through a lot. So how do you actually take all this and apply it? Don't worry, I've got you. Here's a simple, actionable checklist you can use to guide your own analysis.
So here it is, your 5-step roadmap. Step 1, just identify the moat. What kind is it? Brand, cost, network effects? Step 2, verify it. Dig into the financials and find the proof. Step 3, judge its direction. Is that moat getting wider or is it getting smaller? Step 4, put it all together and assess the overall quality of the business. And only then, only after you've done all that work, do you get to the final step, asking if the stock is available at an attractive price.
And that, right there, is really the heart of value investing. It's not just about finding these amazing companies, it's about finding them before everybody else fully gets just how durable their advantage is. Your job is to find that gap between what the market thinks and what you know to be true. And now, you have the tools to start your search.